This is a story about walking a tightrope. India Prime Minister Modi is committed to making India an economic power, and capital markets are what provide businesses with the money they need to start and to grow. But to do that, they need to encourage investors to take risks, enough risk, but not too much, a fine balance we recently saw lost in India's equity derivatives market. As a market maker with a unique model, Jane Street's business makes bets on inefficiencies in markets. Bloomberg reporter Catherine Doherty has been reporting on its business in India.
Jane Street has kept its trading secrets close to their chest, but it was really the Millennium lawsuit.
Jane Street saw an opportunity in India's equity markets, engaging in a strategy called index arbitrage.
So the firm was essentially placing these large bets that were then impacting the other side, and they were profiting from the way that these markets were moving. So the regulators in India have identified this as a manipulative trade, and the firm has said it was an arbitrage trade and not market manipulation.
India's market regulator, the Securities and Exchange Board of India, or Sebi, banned Jane Street from the country's securities markets. Jane Street has filed an appeal alleging that Sebi denied it access to documents it needs to defend against market manipulation accusations. Ironically, the problem with India's capital markets historically has not been encouraging too much risk, but too little. Nilesh Shah has watched the evolution of the country's capital markets as the managing director of Kotak Mahindra Asset Management.
The Indian savings allocation is more tilted towards physical assets. We are one of the largest buyers of gold in the world, putting anywhere between $50 to $70 billion annually. We also have love for real estate. Capital market or financial savings itself has taken off in recent times. But thanks to mutual funds, insurance industry and pension funds, slowly and steadily allocation to capital markets, both debt and equity, is increasing rapidly.
India's transition to retail investing is still in its early stages, but it is moving fast. 1 in 5 households today hold shares, up from 1 in 14 just 5 years ago.
We launched an investor awareness program called Mutual Funds Sahi Hai. Mutual funds are right thing to do. And that has helped us in mobilizing more and more retail savings into mutual fund. Our industry is growing at a frenetic pace, and I believe the nudges from the regulator, the work done by the regulator, is laying the foundation. Now it is up to us as an industry to carry forward the work.
One measure of the expansion of Indian capital markets is the success of its IPO market, which is among the biggest in the world.
Last year, IPOs in India accounted for about more than $20 billion US dollars. It was the number 2 IPO market in the entire world.
Josh Fellman is the principal at JH Consulting and advised the Indian government on economic and financial matters during his time as the director of the IMF's India office. To date, regulators have encouraged retail participation in IPOs, helping contribute to overall retail participation in markets.
One thing that they've been fantastically successful in, as opposed to, say, China, is they've managed to get household participation in the capital markets.
It's not all roses. Under the surface of India's blossoming capital markets is a risk that threatens its stability: derivatives.
About 40% of derivative transactions are conducted by households in India, which is an incredibly large number. So if you take the derivatives market in particular, the regulator, Sebi, did a study. They found that last year, about 90% of the participants in the market lost money. And they found that, again, about 40% of them were under 30. 3/4 of them earned less than $6,000 per year.
The growth in derivatives has caused a liquidity problem.
It is a fact that there are a large number of unsophisticated investors. It is a fact that they have very poor cash buffers. But what to do about it You don't want to push these people completely out of the market. On the same time, you don't want to unduly restrict the professional participants in the market, because they're the ones who iron out the market inefficiencies. So far, it has not had any adverse impact on the ability to raise money through the equity market.
Even if the illiquidity in markets hasn't affected raising capital to date, it has introduced a different kind of risk.
So in India, the options market is quite liquid, the most liquid active market really across the globe. In the US, you also have a very liquid options market, but the cash market, the equity market, is also liquid. It's also trading at high volumes and it's moving very efficiently. And the regulators really have a sense of the big players, and if there's any manipulation or if there's any large moves, they're able to identify it very quickly.
India's financial regulator, Sebi, has made an example out of Jane Street and drawn a boundary in how far it's willing to go to liberalize its markets. But keeping the door open to foreign investors will be crucial for the country.
India is one of the most open economy in terms of foreign direct investment. India's largest FMCG company, automobile company, telecom company, mutual fund, private sector bank, insurance company, all are majority owned by foreigners. There is hardly any other country in the world where foreigners will be allowed to own such kind of industry. However, can we improve further upon this? My favorite example on foreign direct investment is Maruti Suzuki. In the 80s, Suzuki came to set up an automobile company in India. They have gone through the ups and downs of India. Today, Maruti Suzuki, a 53% owned subsidiary of Suzuki, sells more automobiles in India than what Suzuki sells worldwide. And Maruti has delivered better return than Suzuki, Honda, Toyota combined in the equity market since its listing in 2003.
It isn't just equity markets that provide capital to companies, and the debt side of the capital market equation may be about to get a shot in the arm when Indian government bonds are included in several FTSE Russell bond indexes this month.
Essentially, we have seen that whenever a country becomes part of benchmark indices, both passive as well as active flow starts flowing in. So inclusion in FTSE government bond indices will undoubtedly increase allocation towards India. More importantly, when you get an alternate source of funding, for example, all domestic investors are generally on one side of liquidity. Either it's high or it is low. But global investors can bring balancing part.
Indian markets have come a long way in encouraging risk-taking among retail investors and offering channels of investment to foreign investors. But Shah says that hasn't been enough to support the risks inherent in generating the kind of innovation that comes from the success and failures of startups.
Unfortunately, here Indian capital market has not done a good job. Majority of our startups, both innovation as well as otherwise, have been funded by global private equity and venture capital funds. It has been to some extent funded by family offices and high net worth individuals. Like the public market, private market has not received encouraging participation from Indian capital. The second thing is related to instruments. The private equity market, unlisted market is not as much regulated as the public market is. So the domestic flows, domestic retail flows have not moved into unlisted segment as much as it should have done. The third, and probably which is changing rapidly, is creation of angel networks. The whole purpose of venture capital industry is to some extent go from monkey to King Kong scenario. You invest in lots of monkeys, some of them will grow to become gorilla, and one of them will eventually become King Kong.
There was a lot of financing through venture capital, through private equity for Indian startups. People wanted to bring the sort of IT ecosystem that exists in the United States into India So, for example, food delivery firms, which has proved to be an enormously big and very successful market in India. Ride-hailing apps. All these things have been started in India and have proved very successful. A lot of them firms have grown and exited through, the PE firms have exited through IPOs. But of course, more recently, as elsewhere, when interest rates moved off the zero level, a lot of that financing has dried up.
Whether it's reforming taxes on securities transactions, or limiting speculation in cash equities and derivative markets, or making sure both debt and equities are supporting innovative new companies, India is moving, trying to walk that tightrope of risk and stability to support its economic growth. And its very motion means that it can't come to a rest.